Welcome back to the Risk Manager's Corner. In this episode, we're diving deep into life insurance, its mechanics, core risk types, and the frameworks risk managers must deploy to stay ahead. If you're working in life insurance or evaluating exposure to long-term liabilities, this breakdown is essential. How life insurance works. Life insurance is designed to provide financial protection against the death of the insured. There are two primary product types. Term life, which covers the individual for a set period. If they die within that term, a benefit is paid. If not, nothing is paid, and premiums are not refunded. Whole life, which provides lifelong coverage. Premiums are invested by the insurer, and part of the returns build up as cash value in the policy. There are also hybrids. Life insurance with critical illness cover, over 50s, guaranteed acceptance policies. Income protection insurance. These combine protection against mortality, illness, disability, and loss of income. Inherent risks in life insurance. Life insurance carries a different risk profile compared to general insurance. The risks are long-dated, actuarially complex, and sensitive to demographic shifts. Here are the major ones. Longevity risk. This is the risk that policyholders live longer than expected. That's a problem for annuity products where insurers pay out for life. Longer lives equals more payouts, equals strain on reserves. Mortality and morbidity risk. This is the opposite of longevity risk. It's the risk of death or sickness occurring more frequently or at higher cost than assumed in the pricing model. For example, a spike in early cancer-related deaths or an epidemic can wreck your assumptions. There's also catastrophe risk. If a pandemic leads to multiple high-value claims that exceed reinsurance coverage, losses can spike beyond your capital buffer. Persistency risk. This is the risk that policyholders cancel their policies earlier or more frequently than expected. This hurts insurers in multiple ways. You lose expected future profits. You fail to recover upfront acquisition expenses. You risk reputational damage if lapses signal poor advice or customer service. Whether lapse rates are higher or lower than expected, both scenarios distort pricing assumptions and reserving needs. Claims management risk. Poor claims. Handling increases payouts, reduces fraud detection, and eats into profitability. If controls are weak, valid claims may be underpaid, damaging reputation. But if excessive or fraudulent claims are paid, losses spike. Underwriting risk. This emerges when poor practices allow in-bad risk without charging enough premium or applying proper exclusions. This often happens in fast-scaling firms where the pressure is to grow, not scrutinize. Poor data, rushed onboarding, and lax medical checks all feed this risk. Product cycle risk. This is strategic risk. It occurs when firms fail to review products regularly, keep selling unprofitable lines, or miss the need to evolve products based on emerging experience. Expense risk. Life insurance involves high acquisition and maintenance costs. Expense risk arises when actual costs exceed those priced in. That can break the business model if left unchecked. Risk appetite in life insurance. Every life insurer must set a detailed risk appetite across all risk categories. This includes maximum longevity exposure per annuity line, maximum sum assured per life, reinsurance levels for mortality and critical illness, persistency tolerance, bands by product and distribution channel, underwriting and claims management quality targets. Life insurance, risk appetite isn't just a capital issue, it's also operational, reputational, and strategic. Risk, identification, mitigation, and management. Risk functions in life insurance should regularly assess. Emerging trends in lapse behavior, mortality and morbidity shifts, claims, fraud trends, underwriting quality across branches and digital channels, Stress tests on cash flow and reserve adequacy under adverse conditions. Predictive analytics is your ally here. Build dashboards that track deviation from expected behavior in mortality, lapses, and claims severity. Use actuarial tools but combine them with behavioral data and distribution intelligence. And don't forget to model correlation risks. A downturn in the economy could increase lapses, increase stress, and increase death rates all at once. Minimum risk management standards. Any life insurance business should adopt the following control measures: quarterly reviews of persistency and claims experience, independent audits of underwriting decisions, reinsurance strategy reviews, including event limits and counterparty exposures, clear limits on total exposure to high-risk cohorts, e.g., smokers, elderly clients. Escalation frameworks. When lapse spikes, claim patterns, or mortality deviates from plan. Without this, it's just hoping the actuaries got it right. And that's not risk management. Life insurance looks calm on the surface, but it's actuarially intensive, operationally fragile, and strategically high stakes. As a risk manager, your mission is to blend quantitative insight with operational rigor, to catch problems before they catch your reserves. In the next video, we'll dig into reinsurance, how insurers protect themselves, what can go wrong, and what you should always verify in reinsurance treaties. Hit subscribe and stay with us. You're building mastery, one layer at a time.